to our 1031 Tax Deferred Exchange video featuring Phil Atwan with Exchange Resources. I'm Marianne Bean, and this is Mike McDonald. We are with Compass Real Estate. Hi, Phil. How are you?
Marianne, good afternoon. I'm doing well. How are you and Mike doing?
How are you doing, Mike?
Fair to good.
We're fine.
Just depends. It's like
We've already lost credibility on this.
I have a few hours left, so I'm just
recording right now.
I'm going to go ahead and share our screen to get us going. And I think the primary question Mike is going to start us off with today is, what is a 1031 exchange, tax deferred exchange, for those who are not familiar?
I'm going to ask you.
You're going to ask.
You
But I just asked it.
Hey, Phil, I've known you for a long time. I know, and you're really good with these exchanges. But I wanted to start this kind of for like a beginner. What is a 1031 exchange? Why would someone use it? And what are the benefits to it immediately? Or
Sure. In fact, I just got that same question last Saturday. I was doing a Ventura County radio broadcast by a group of real estate agents who are on the radio every weekend. And the bottom line is, they asked me the same question. I'm going to answer it the same way as I did for them for you. A 1031 exchange is part of the tax code. It's called the Internal Revenue Code, also known as IRC. Congress voted this in back in 1921. So technically it's 102 years old now. And what the federal government created was a way to sell your property. Now, it's not your personal residence. It's not your second home. It's not your vacation home, but it's a property that either you charge rent on or you utilize in your business, or even vacant land. When you sell those properties, or any kind of those properties, you pay something called capital gains taxes. The CPA will figure out what the capital gain tax is, and you'll pay 4 different kinds of taxes, of which I can get into a little later on. But what it does, it actually defers the payment of tax. It's not tax-free. But the government says, through this exchange program, you can sell your rental or business use properties and acquire other rental or business use properties in better areas or better buildings anywhere in the United States. And the government will let you defer the tax. Now, what does that mean? It's not tax-free. It's tax deferred, which generally means this, is that your basis of what you paid for originally on that property and all the capital gain of that property goes with you into the acquisition of the new purchase, which means the gain is still there, the low basis is there, but you don't have to pay that 28 to 45% capital gains taxes to sell and buy and to get into better properties for you. So that's what a 1031 exchange is. It requires that a third-party company called an accommodator, the IRS calls this qualified intermediaries, sets up this exchange while it's in escrow. So we set up all the paperwork. Once the sale closes, generally speaking, you have 180 days to close escrow on your new replacement properties. But the caveat or the catch is that the first 45 days is your deadline to name what you're going to buy. We can get more into that a little later on. But that's what a 1031 exchange is. It's simply a trade of what you have for other properties that'll be better for you for 3 main reasons. Number one, you're looking to increase your cash flow and your rate of return on your investment. You want to get more money per month based on more doors. Number two, you're able to diversify your portfolio. So instead of having all your equity in just one property, maybe you move it into more than one building. So when the market goes up again, in fact, it's still going up right now. In a lot of places, prices are actually increasing because of the lack of inventory. But when it does go up, you're now inflating or appreciating with multiple properties, not just one, which means you take advantage of markets that are going up. And then thirdly, you create additional, by buying up, additional tax write-offs. Why? Because the government wants your money. They're going to tax you as hard and as fast as they possibly can, both federal and state. Well, the beauty of this exchange, it allows you to buy up to create more depreciation and more tax write-offs, that will hold them back at bay and hopefully reduce the amount of taxes that you pay annually on the income that's generated by the property. That's in the short end of what a 1031 exchange is. And it's utilized by investors nationwide for the last 102 years.
Well, let me ask you a question, because to go with that, when you defer it out, it's obviously it stays, but there's also something, isn't there, that if, and I've talked to a lot of people, well, I'm waiting for either my wife or myself to pass, and then we're going to sell it because they'll get a stepped up basis, correct?
That's right, but you have to qualify for the stepped up basis. First of all, in case your viewers are not sure, what does that mean, stepped up basis? That means that if you sell it today and you bought it for 300, it's worth 3 million, you've got a 2.7, this is a gross example, but you have a $2.7 million gain of what you're going to pay.
Before you take out all the expenses and what it costs you to do all that stuff, right?
Well, that'll be included in that.
Right.
You will pay taxes on the difference, and that's a killer. But if you have your property in a trust, or if it's set up by an estate planning attorney in a different type of method, when your spouse dies, or when you die and it goes to your heirs, could be your spouse, could be your kids, could be whoever you're deeding the property to, Marianne, whatever it happens to be, they receive the property not at what you paid for it, and then you pay the taxes on the difference, but at the current value, the date you or I passed away, which means they get it with no effective tax if you sell the property, at least not capital gains taxes. So that's what a stepped up basis is. It is a huge, I mean, a huge exit plan for people who own real estate, because real estate goes up over time, folks. That's just the bottom line. That's why people buy this stuff. I mean, it produces income, it goes up in value, and it creates tax write-offs. So the bottom line is, why not take advantage of this in your estate plan with a good estate planning attorney, which that's who we see when we set up a trust or whatever vehicle we're going to put it in. So we can spare, and by the way, we can spare our heirs all that tax. And number two, do you know the government actually created specifically that way in 1954? In 54, they were trying to create an exit plan for people who have stuff that they've created, and then ultimately when they died, they did not want to create hardship on behalf of all the heirs to inherit those properties.
Well, so then this question to go right along with that, the heirs take it, and we have told some of our clients, you might think about selling, and well, we don't all want to exchange. You know, some of us want cash. That's fine. You could split the exchange up, take some of whatever you use. That's like for my portion with my brothers, say, I would get my portion, I would exchange it. They wanted their cash, they'll pay taxes on their cash, correct?
If it's in a trust to do that, the answer is yes.
Right.
But for example, let's say you want to sell a property, but you need $100,000 for whatever personal reason, you know? And the bottom line is, you can do something called a partial exchange, where you defer a part of the tax, but not the whole tax, because you're taking cash boot, is what the IRS calls it. You're keeping some money back, because in an exchange, you're supposed to reinvest all the cash from the sale into the acquisition, and by equal or greater than what you sold for. So you're absolutely right. You can do a partial exchange, or if it's in a trust and somebody wants to just take their cash, other people want to just redistribute it or whatever. There's lots of different ways of doing it. You just have to get some good tax professionals involved in it. And if it requires an exchange, they'll need a company like ours to facilitate that 1031 exchange.
But you have to replace the debt also too.
Yeah. I'm not sure if we're covering that on.
Yeah, let's save that for the end, because I feel like that's a little bit more in-depth answer. So we answered the first question, which is the 3 most important motivations for staying in an investment, in investing real estate. And then the next question would be, how do I get my investment properties to work harder for me so I don't have to?
That's a good question. This is really important, folks, for anybody who's watching this video. And a lot of people don't realize this. There's 2 things in a property. There's cash flow and there's rate of return. And most people understand cash flow, because those are the green bucks you see every month. Everybody understands that part. But what they don't know what a rate of return is And I'll give you an example. Let's say you have two identical properties you bought at the same time. They're on the same street, in the same city, with the same floor plans. I mean, there's nothing, absolutely nothing different, except one has more equity than the other. That's it. The one that has more equity, even though it's an identical property to the one next door to it, can't charge more rent because it has more equity. Because rents are not established on how much equity you have in a building.
Right.
It's the fair market value of what rent should go for those two identical properties. So the rate of return on the property that has more equity is lower because it can't charge more rent because it has more equity. Whereas the property next door maybe has less equity, but it's getting back the same dollar of rent as the one with more equity gets. So the bottom line is the rate of return is higher when you leverage. And that's what people do. They leverage so they can have more doors, more buildings, more units, commercial, residential, industrial, really doesn't matter, that will pay them rent. Because the more often you get paid rent in a month's time, you'll start seeing those green bucks. And when the property rents grow up, and I understand that's a big issue right now in the city of Burbank, as it is throughout the state of California, but as those rents go up, you're going to take advantage of more front doors that are raising rents, and that produces income. Another way to make your property work hard for you, and I just mentioned that, when inflation goes and appreciation will continue to happen, and it goes in cycles, right? We have up cycles, we have down cycles, just like we're in summer now, but later on winter will come and it'll rain again. Cycles change all the time. But as the property values go back up again, what happens is you want to inflate with more properties as opposed to all your equity in one building, because you're getting a lot more back from the growth of real estate. And that's just the way it works.
So you're saying that if you owe more, then the rate of return is better.
The higher the equity, the lower the rate of return.
That's what I'm saying. If it's the debt or how much you owe on it. Yeah, right.
Right. And then ultimately, when people get older, you're looking at Santa Claus, like you said earlier, with your hair turning white and everything. Many of us don't want to be landlords anymore. And what we'll do, or we'll exchange and we'll go to either other places where they're going to be a little nicer to us, the way they're going to treat us compared to they do the tenants than they do here in California. And ultimately, I can get a higher rate of return because prices are less in other places, but the rents are less, but not as much less. So the bottom line is I can get a higher rate of return. And frankly, I mean, I want, like I said, manage. So I can go into commercial or residential or triple net or something called DST, as a Delaware Statutory Trust, where we can have corporate tenants and we don't have to babysit getting a paycheck every month for that lease that's held by that corporate tenant. So there's lots of different ways to make the properties work harder for us so we don't have to. Right. And the 1031 exchange will take you to all those different places.
Fantastic. So what is the rate of return in each of my properties? And then you have a formula for us.
Yeah, this is really classic. It's really good. Is it 100% right on? No, but it's about 95% right on, because we can't calculate depreciation because everybody's situation is different. So we have to keep it generic. And I did sit down with a couple of CPAs and they helped me put this together. First of all, and a lot of people they say, well, I bought my property for this, but now it's worth this. See? So why should I sell? Or my rents used to be here, but now they're here. So why should I sell? Well, my property taxes are still lower because I bought it way back with Prop 13. Why should I sell the property? And my question is, well, that's really a good question. But what is your rate of return? And they have no clue what I'm talking about. So this is how it works. Number one, you look at the gross income. How much do you collect per building? Now, maybe your building has one front door. Maybe your building has, 18 apartments, doors in it. It could be commercial or residential or industrial. It doesn't matter. My question is, what does your building gross each month in terms of rents, gross rents? Number two, how much does it cost you? Your mortgage payments, your insurance, your taxes, your maintenance, your utilities. What if you have to evict somebody? Don't you have to do a tax return and go in front of a CPA? What happens when you got to clean up a unit when it becomes available? What does it cost you annually? And by the way, 1 and 2 are on your tax returns, on your Schedule E. You can go back and look if you don't remember. Number 3, you subtract 2 from 1, that gives you number 3. That is your net. It's like Mike's dad used to tell him, son, it's not how much you make, it's how much you keep. And he's right on target, right? And that's what the answer to number 3 is. Number 4 is interesting. You figure out what your net equity in the building is. Well, what is net equity? Well, net equity is this. If you were to sell your property today and subtract the mortgage and debt against it, what would be left, right? That's the question. What would be left? And what happens is that that's what you will, you, Marianne, and Mike will compute for your clients, because they're not sure. They can guess what the property would sell for, but they're probably not 100% close. And the bottom line is, professionals, you'll be able to answer that question. Right. Then lastly, number 5, you take the answer to number 3, which was the net income, and then you divide it by number 4, the net equity. And that will tell you what your percentage rate of return is on the equity. In other words, if you were to take the equity out of the building and go to the Bank of America or Chase or wherever you're going to go, first question you're going to ask is, what's the interest rate? Well, that's what I'm asking you. What is your interest rate? What are you getting back for all the equity that's in your building? You will be very surprised once you do this. Now, remember I said earlier that the higher the equity, the lower the rate of return?
Right.
This will tell you what it is. And when you see that, you know what you're going to do? You're going to say, I did something wrong. Let me do that again. But something's going to be really funny here, because you're going to put in the same numbers and you're going to get the same answers. And until you understand what your actual rate of return is, that tells you how lethargic the equity is in your properties, or how hard it's working for you in terms of rate of return. And I can tell you, just because I've been in the industry for 41 years, and specifically just the 1031 exchanges for the last 25 years. It's a quarter of a century. And I can tell you, I have rarely ever seen any property that's been held for 12 or 15 years or more barely hit a 4% rate of return. Most of them are closer to 2.
Right.
So you're going to have literally tens or thousands or hundreds or millions of dollars of equity getting that much return. And it doesn't make sense when you could re-leverage it and go to bigger, better properties and do a 1031 exchange.
And that's the thing that I think most people don't calculate in their mind, or they don't, it's not clear to them, because they've owned a property for 30 years and they think, well, man, I spent $25,000 when I bought this building and now it's worth $1.5 million, $2 million. Well, it's worth
more,
but that money's not, it's just in the building. It's like, you might as well build it into the concrete. It's not working for you. It's not making you money. It's just sitting there as a structure that's depreciating. It's causing you maintenance costs. It has tenants that complain, possibly lots of aches and pains that are costing you money. And what you're bringing in rent is not equal to the value of that property. So you might as well turn it around and build it into something new that's going to bring you a higher rate of return.
without a doubt. And I guess your viewers, I would ask them to just take a picture of this, right? Do the math, ask Mike or Marianne to help you figure out, what your net equity is in the building. You'll have to tell them what you owe currently on any and all of your loans on the property. And then you'll be able to see what your rate of return is. And then you can make a decision. Am I willing to put hundreds of thousands or millions of dollars of equity in a 1 or 1.5, 2, 2.5, 3.5% return. Heck, why not sell it and go to the bank where you can get 5 today and not have any of the hassles? You know what I'm saying? But that's why it makes sense to do this 1031 exchange. It just does. Into better property that suits you, to the level you want to manage, into the areas that you like the laws better, the way they treat investors versus the tenant. I mean, there's got to be a balanced playing field here, folks, for both parties, right? And it just isn't where we are here today.
This is exactly what you did for me with my client Brian years ago when we were selling his father's properties and taking him out of these little 3 and 4 units and buying 10, 12, 20 unit buildings. And he had more doors, like you said, and more income. And obviously his debt went up, but that was okay, what he owed. But like you said, they got a bigger return on his investment then.
Right.
Yeah. And Mike, if you think about it, let's say I have a single family, okay, versus let's say a 4-unit building. If I lose a tenant in a single family, what's the percentage of rent I lose until I get another tenant? The answer is 100%.
Yeah.
Well,
If I have a 4-unit building and I lose a tenant, what's my percentage of income loss? The answer is 25%. That's called diversification. That's called not putting all your eggs in one basket. And that's why these people do these exchanges, different places, different types of properties, to diversify, so they're not putting all their eggs in
one basket.
Yeah, pretty much.
Yeah. So your next question is, have you updated your properties with your estate planning attorney? I don't think most people have an estate planning attorney or understand the significance of having somebody who's kind of helping you oversee what's going on with your estate for your heirs.
Well, that's a good question. The bottom line is, if you're not keeping your trust up to date, well, first of all, do you have a trust? Or if you have your properties in LLCs, did you know that your trust can be the shareholder of your LLCs? So you can get those stepped up basis, you can take care of your estate plan. You've got to have an exit plan. It's not right that you work this hard all these years and just will it to the government. 40, 50% in taxes. It just doesn't make sense unless, you're really happy with the government and you want the government to have all your money. And that's fine if that's how you feel. But the bottom line is, if you don't feel that way, you need to sit down with a good estate planning attorney who understands what we're talking about, and they will create a plan and a trust or some other types of vehicles that will fit you the best, so that you will take care of your heirs and the people that mean most to you, or the organizations, because you may want to leave it to a religious organization, or you may want to leave it for some other foundation or something. Whatever it happens to be, you can master your estate and control it after you've passed, because it tells who gets what, when they get it, how they get it. It's just a great way to plan your future, because you've pre-planned it through this planning with an estate planning attorney, trust, or whatever vehicle they wind up using.
I'm always surprised how many people don't have a trust, and don't hold their properties in their trust. I've met a lot of people, they're like, oh yeah, we have a family trust. And I said, well, is your property in your trust? No, our house isn't in our trust. I said, so do you want to give the state of California your property? No, so maybe you want to put it in your trust, or they forget, they go, oh, we were supposed to do that with our attorney, but we never got around to it. Well, you don't want to be morbid, but you want to say, tomorrow you could get hit by a bus and you didn't get around to it, and now your kids are going to have to deal with probate.
Or you didn't see a cardiologist and you died of a heart attack.
Yeah.
I mean, the whole part is that, the bottom line is, people don't plan to fail. They just don't.
Yeah.
They just fail to plan. And if you're listening to us right now, you will be another statistic of what we just said, unless you make it a point. Spend a few $100s. It's the best remedy for your estate and the people you love, better than almost anything else, at least from a financial point of view. Fair enough?
100%.
So do it.
So what is a 1031 tax deferred exchange? We went over this briefly in the very beginning. it's a much bigger answer than what you're capable of giving today. But I feel like people have to have a general knowledge of what it is that they're entering into or considering entering into when leveraging their investment property.
What's really important is that we answer this question in terms of what taxes you get to defer when you do this exchange. There's 4 major taxes. A lot of people don't realize that. People say, well, the capital gains tax today is 15%, but a 20% cap on it. There's a bill right now at the White House has put down for the 2024 fiscal year that says they want to raise the capital gains from the cap currently at 20% up to 39.6%. I mean, the bottom line is the government wants your money, folks. And so you need to know what exactly you're deferring from what you're selling to what, in terms of taxes you would pay, to what you're buying by utilizing the exchange. Well, I already said the first one, it's 15 to 20% on a long-term capital gain. The second tax you pay when you sell the property is called the Affordable Health Care Act. Some people call it the Medicare tax. Some people call it Obamacare. Honestly, I don't care what you call it. You have to pay it.
Right.
It doesn't matter if you're selling your personal residence, your second home, your vacation homes, your mutual funds, and your stocks, or your investment property. You will pay that tax of 3.8% to go into that system unless you do a 1031 tax deferred exchange. The third tax you pay is to the state of California. California, I'm a native. I think it's a beautiful place. I've always lived in Los Angeles County, but the bottom line is, California is the highest tax state in the United States of America. It's higher than New York. It's higher than New Jersey. We've overtaken them. We've passed them. And guess what? Today, you will pay to the state of California between 9.3 to 13.3 as a cap. But guess what?
They got more online coming for us.
Why? Because California is officially broke.
Yep.
We've been spending more than what we've been taking in. People say to me all the time, well, Phil, the rich never pay taxes. Well, really? I think California is a perfect example of how they do pay taxes, but California got so ultra aggressive with the people that they moved away. It used to be that 40% of the people paid 50% of the state tax in California, but they've left the state. So much so that our illustrious governor tried to pass something that says after they leave, they can still collect taxes for another 10 years. Yeah. Well, that didn't go through. And the bottom line is, currently, like Mike just said, the state is talking about raising the highest tax rate, which is clipped at a cap of 13.3 to between 16.3 and 18.3. They're talking about that today. They actually tried to pass that in 2020 when we were in COVID because the state was ran out of money and they were bleeding. So what happens is they had an emergency session and they couldn't get it passed. But now, because we're still losing money, they can't even pay their bills to the feds, but the state of California owes. The bottom line is they're talking about this all over again, and they've got the votes to do it, folks.
Right. It's kind of crazy.
But that's not the last of it. There's a fourth tax. When you sell the property, this wonderful depreciation that you've been able to take. And that's a wonderful thing. If you're in a residential building, you get to take it for 27 and a half years. If it's a commercial building, you get to take it for 39 years. You don't really depreciate the value of the land, just the value of the building in the year that you purchased the property. And they divide it by 27 and a half if it's residential, or 39 if it's commercial. And then that capital improvement or the building all gets chopped up into 27 and a half pieces. And that's how much you get to write off each year for the next 27 and a half years. Well, guess what? Whatever the allowable amount of depreciation, you as either an investor on your investment property or you who have property as business use, you get to take this depreciation, which is a wonderful thing. It's a great thing, except when you sell it. Because when you sell it, they're going to charge you a 25% tax on all the allowable depreciation you were allowed to take,
Right.
whether you took it or not. So if you opt not to take the depreciation on a property that is allowable to take depreciation and use it, and I'm taking a conservative amount, $400,000, you pay a 25% tax on the allowable depreciation, which would be 100,000, right?
Mhm.
And you pay that tax whether you took the depreciation benefit or not. So it's a really big amount of money that you should be taking, and don't let your CPA tell you don't take it. Take it, because you're going to have to pay it back in terms of a 25% tax when you sell it. And those, my friends, are the 4 taxes that you pay when you sell your rental or business use property.
Without an exchange, right?
Without a 1031 exchange. It
It-
defers all that into the acquisition of the new property. That's an incredible gift.
And you can take that with you to other states as well. Doesn't matter.
That's right.
Because I know
We're in the USA.
Well, I just know when you sell your own home, they tax you and they take a bunch out of it that you keep. They don't want you taking it to the next state. So anyway,
Yeah. And I
Yeah,
will-
California created a form that you now have to fill out each year because they want to chase you and know exactly what's happening. And so they can follow you, that you don't sell the property that you exchanged into, that you went out of California. And you have to file that each year. Why? Because California has something called a clawback measure. You know, we have a bear on our flag. The bear has a claw, the claw claws back, which means that anytime after you exchange, if you sell the property in a taxable sale and not do another exchange, California comes back and claws back, not at today's rates, but at whatever the rate is at the time that you sell in a taxable sale. So they'll claw back, but probably at a higher rate. So you have to be aware of that. And it's very simple. You just file one form every year. You do a tax return. You send it back to the state of California that says, hey, can't get me. I sold the property. And by the way, if later on you die, not if, but when,
yeah,
and it goes to your heirs, right?
Yeah.
Right? Guess what happens? They get a stepped up basis, and California gets
Zero.
Is there a time frame on that clawback?
you have to report it every year. If you don't, California considers it as a taxable sale, and they will come after you. The franchise tax board will come after you. By the way, franchise tax board has offices all over the country, not just in California.
Right.
They're always looking for money and people who are leaving.
Okay, so what is a like-kind property within a 1031 tax deferred exchange?
I got to tell you, this is probably the number 2 question I get. I speak at 120 to 150 seminars every year for the last 25 years. That's probably the number 2 question I get. And this is what the answer is. If I'm selling, let's say I'm selling a condo, and it's been rented for the last couple of years or longer, and I decide to do a 1031 exchange, but I want to buy vacant industrial land out in San Bernardino because I got a hot tip. They might be putting an Indian casino up there, and I'm going to buy some dirt right around that same area where its builders are going to want to build on it and do construction. I can make a killing just by holding that. Is that a like-kind property, a condo, single family, residential to vacant industrial barren land? Most people would say that's not a like-kind exchange. According to the United States government, it is a like-kind exchange because it's the sale of investment real estate, which your condo that you rent out is for investment use for income for 2 years or longer. The government says you can go and buy any kind of other investment property, and vacant land is considered property. It may not generate income, but we buy it to see it what? Go up in value. I mean, think about it. Don't you wish you had bought some vacant land in a city whose last name is Beach, Huntington Beach, Manhattan Beach, Newport Beach, Laguna Beach? I mean, folks, we can talk about this a long time, but it doesn't really matter if it's at a beach or not, but it just goes up over time. And that's what makes it like-kind. What's not like-kind is if you're selling or buying any property that you're planning on living in. That is not allowable. Or for your second home, your vacation home. So if you want a place down in, I don't know, Orange County that you're overlooking the water, in Newport, Laguna, whatever, that a second home is not for investment use, it's for personal use. So it's not like kind. You can't exchange out of it. You can't exchange into it. It's because it's for personal use. It's got to be investment to investment. And investment is described in three ways. Rent it for the last 2 years that you'll continue to rent, or you use it for your business, or number three, it's vacant land. So if you're going in and out of any one of those three, in and out into one of those three, it's considered like kind. So personal use can't use. Now, next question I get really quick is they say, well, but I'm selling a fourplex and I live in one unit, but the other three are rented. So which one is it? The answer is it's both, because your CPA has been depreciating, or should have been depreciating, the three that has been rented, and you've been declaring your income on that. So it's different, even though the one you live in is on the same lot. So the CPA prorates the investment from the personal. And so that means you could exchange as like kind the 3 units that are investment into whatever you want to go into that's investment. And the other way around is true. If you're going to sell a single family rental, but you want to buy a 3-unit building and you want to live in one of the units, you're really only exchanging into the other 2. So as long as the other 2 are, to steal from Mike, equal or greater than value than the one that you sold, it's perfect. You've just met the requirement of like kind in an equal or greater property, because it's about what you're selling that's investment and what you're buying is investment of equal or greater value. How do you like those apples, huh?
Good answer. Good answer. So can I take my investment properties to another state rather than California?
Absolutely. I think we beat that to death a couple of slides ago.
Yes, and it's advised right now.
Yeah. And by the way, for some of your more sophisticated investors, some people own property other places other than the United States. By
Right.
law, they have to declare income, especially to California, because we charge world tax. So here's the bottom line. You can exchange in a domestic property to a domestic property. But you could also exchange a foreign property to a foreign property as a U.S. taxpayer. But you cannot intermingle the two together. And you cannot believe how many calls I get for people who want to sell here and buy in Mexico or in Chile or in Costa Rica or the Middle East, or Canada. It's got to be domestic to domestic or foreign for foreign. And the IRS will honor that through the 1031 and tax deferred exchange.
Very interesting. Are there time limits within an exchange? And this is always my favorite question when we have clients who want a 1031 exchange. It's always, they ask multiple times, either because they can't wrap their heads around it, or they forget, or it can be confusing because you don't do it on a regular basis.
No, you don't. And we want to be patient with those people, because we do it every day. They do it, 2-3 times a year. In their lifetime, I should say.
Yeah.
Yeah, right. So we set up the exchange prior to closing. Once the sale closes, they have 2 time periods they have to adhere to. Number 1, the first 45 days after the sale closes. So the closing date is the initiating of these 2 time periods. 45 days to name what you're going to buy, and 180 days to close what's on your 45-day list of property addresses. Under the 3 property rule, you can have up to 3 different properties. Now, you can go more on a second rule, but let's concentrate on this one, because this is what 95% of the people are going to do. They're going to name up to 3 properties in that 45 days. They can change those addresses 100 times, but not after day 45.
Right.
So whatever's left on the list at the end of day 45, those are the only 3 they could exchange into. When they open escrow on their purchase, doesn't matter. What matters is that they close and take possession of any one of those identified properties in any of the balance of the 180 days. They could even open escrow on a purchase first before they even open escrow on their sale. The government doesn't care when you open escrow. They care when closings happens on your sale and closings happen on your purchase of 180 days later, not to exceed. And by the way, if the 180th day lands on a weekend or a holiday, you do not get the next business day. It's that day or before. It's not like tax returns, folks. And the bottom line is what you buy better be on that list. And if you want to diversify and buy 2 or 3 of them into different places, you can do that through the 1031 exchange.
So here's the $10 million question. Every single person who's watching this is going to ask, what happens if my escrow closing gets delayed?
You pay taxes. Some people call it going into the electric chair. That's what Mike told me, at least. No, you pay taxes, which to some people is about the same as going into the electric chair, I guess, or the gas chamber or whatever. But the bottom line is you will pay taxes. The government, I look, they don't play the fuzzy and the warmies with us.
Care. Yeah.
They don't.
Yeah.
They don't care. I kid you not. We had a client who had a heart attack and cancer at the same time, and the government would not extend it for them. We had another client.
And what, his wife or the
exchange?
Probably, right? And I had another guy where the first 2 properties that he put on his list were bought, and he couldn't change it because he went beyond day 45. The 3rd property, he found out after he got into escrow that the seller lied to him. There was all kinds of problem in the HVAC system. Anyway, the seller didn't disclose it, and he petitioned to the government because this guy didn't disclose it and lied to him, and the government doesn't care.
Yeah,
they just don't, not about this. So you got to close in 180 days from the day the sale closes, and what you buy has to be on that list at the end of day 45, and that's the bottom line.
Yeah.
What's that, Mike?
Well, I guess she was going to ask it. But...
So that goes into the next question, which is, would it be better to do your exchange backwards?
Oh,
more and more brokers are saying yes.
I was going to ask on the last one. That's why we're not even asked. That's why when we say it's an exchange, we say that the buyer will cooperate with the seller on the closing, so that we can extend the closing to help us. You know what I mean? More time. But anyway, so that when we get the 45 and 180
are covered.
Yeah. So
that's the best way if you can't do it backwards. Now, what's a reverse exchange? It's closing the purchase first and then closing the sale up to 180 days later. But there's a problem. Where's the money going to come from? Because if it's tied up in that sale property and you need to close the purchase first, how do you get it? The answer is there's swing loans, there's bridge loans, there's line of credit, there's hard money loans, or some people, believe it or not, and maybe one of these people who are listening to us right now are one of those folks, they're just sitting on a bunch of cash, and they can float the money and close the acquisition first. And it's not those two either. And by the way, but somebody forgot to tell me this was a comedy. Anyway, you can close the acquisition first, and the government will let you do that, but only through us. Example, I have people who call me up, and they'll say, Phil, I need to do a reverse exchange. I closed my purchase 3 weeks ago, and now I'm in escrow on my sale, and I want to exchange in the property I've already purchased. Well, I got news for you, folks. You can't buy from yourself. The government won't let you do that. We have to be involved in a reverse exchange 2 weeks before the purchase closes, and we have to set up a holding corporation that will hold the title to the purchase until the sale closes, and then we give you the purchased property. And that's how the IRS wants it to be done. We have to set up this holding corporation. It costs more to do it this way, but guess what? You buy exactly what you want, because it allows you to buy in the location you want, the building you want, the condition you want it to be. I mean, it's all about the purchase property, and some people just feel better to spend extra money to go through this reverse exchange and then get reimbursed when the sale closes.
Right.
And then if there's any cash left over, then we do the principal pay down on the new acquisition. And that will work in a reverse exchange where that will not work in a regular delayed exchange. So there's a lot of benefits. I'm trying to remember, I think the IRS officially passed this. I think it was October of 1999, I think it was, when they passed this. But the bottom line is it's allowable. They'll let you do it if you've got the capacity to either have cash or to get cash and supplement it with another loan from a bank or a person. It doesn't have to be an institutional bank. It can be a person. It can be a Mike. He carries it in his wallet, for crying out loud. I mean, the whole point is he played NFL football. He should be. Anyway,
Everybody remembers
wrong era, right position. So
I think you said something that was really important that maybe people didn't hear is the importance of including your 1031 tax deferred exchange accommodator in your escrow before closing. Most people don't understand they have to inform escrow, and they have to hire an accommodator to handle the exchange during their transaction or before their transaction starts. Because if you don't tell people what your intentions are, you're going to lose out and you're going to end up paying those taxes.
I got a call this morning from a guy who says, yeah, I want to do this exchange. Sounds great. So when you're closing? Today. Folks, give us 2 weeks before you close anything, because it takes time to set up paperwork between escrow and us. And then ultimately you got to sign the documents. So we have to get all this done before closing. So we implore you.
Yeah.
When you fill out the 593 form when you're selling property, it's going to ask you an item number 10. That's a California state document that escrow is going to look at. It's going to ask you a question on item number 10. Are you doing a 1031 exchange? Don't leave it blank. It's the answer yes or it's no.
Right.
Now, you can change your mind a week before that, and then we'll have enough time to make the adjustment and have it all between escrow and us, but it's doable.
Yeah.
But don't call me the day after, and please don't call me the day of. The bottom line is you've got to get this set up. It's just a little bit of planning.
Well, you need to have a real estate agent that knows what the heck's going on and be able to prepare you to say, okay, you want to do an exchange. Let's call somebody. We have these people.
We have Phil. Let's go.
Well,
yeah.
I guess we're not allowed to give one recommendation. We usually give two, and that person, the second one's usually dead. So
I've not heard that one before, but
anyway,
where does that put me?
no, well, hey, better be breathing then. But anyway, you get where I'm going. Yeah, that's what we.
Yeah.
So
and honestly, and I don't mean to be tooting your horns, but the bottom line is, whoever's watching this video, these people know what we're talking about, folks. They're going to ask you those questions. All agents can do that. They just haven't been trained to do this. Yeah. And there's just, you got to work with people who understand this stuff.
Agreed. So last question, how much do I need to reinvest within an exchange? And this goes along with what you were talking about earlier, which is the boot and how that works.
If I sold for $1 million and I have, let's say, no loan, no debt against the property, it's paid for property, but I have closing costs I have to pay. I have to pay commissions. I have to pay escrow. I have to pay a title company to guarantee the title insurance for the new buyer. I have to pay the transfer taxes, the county transfer tax, and some cities encourage transfer tax as well. I have to pay recording fees of the new documents of the new ownership.
HOA fees.
HOA fees, that's actually a reoccurring cost. But if I'm selling a condo, I do have to provide the HOA bylaws and the rules and regs I have to produce maybe a copy of the fidelity bond, so I have to pay the HOA. Those are all one-time costs to sell. So if I sold for $1 million and my one-time cost to sell was, let's say, $70,000, that means my net for my sale is $930 because I have no loans to pay off. So my new purchase needs to be $930 or greater. And all the $930 passes through the qualified intermediary, the accommodator, into the acquisition of the new replacement property, all of it. If you buy for more, but you still put some cash in your pocket, you pay taxes on the cash you put in your pocket. You're not to touch money. It's just like a trade. I'm selling this to buy this, and this is going to be better for me. So you have to reinvest all the cash. Any cash, like we said earlier, Mike, I think it was at the beginning, you pay taxes on the difference if you touch that money. Number two, sold for $1 million, $70,000 in non-recurring closing costs, leaves me a net of $930, but I have existing loans on the property. I may have a first and a second, or a HELOC or a line of credit, whatever it is. Those all have to be paid off at the close of the sale. So let's say there's $400,000 of debt on my property. So the $930 that I have left over from the sales price after the closing cost minus the $400,000 leaves me $530,000 worth of cash. That goes to us. That goes into the acquisition. But we just said you have to buy for $930. So that $400,000 that you used to pay off all of your loans that the title company paid off is required that you reborrow that loan, the $400,000 or more on your acquisition, to go with your $530,000 that we are holding for you. That's how you buy for $930. That $930 is equal or greater. Right. If you want to buy up or add more cash to the purchase, you may do so. If you want to buy above $930, because you may want to buy for $2 million, whatever it happens to be. But you can add cash, you can add additional mortgage. You just can't touch money, and you have to buy for equal or greater than what you sold for. It's not the sales price. It's the sales price minus the one-time non-recurring cost to sell. And that's how it works.
It probably would be wise to put more cash in, because then rate of return is going to change, basically.
Most people will supplement it with debt. Absolutely. We've seen CPAs time and time again tell people who have paid off properties, you got to get rid of this property and do a 1031 exchange, and you're selling for $1 million. You need to buy for $2 million. They go, why would I want to do that? He said, because you're paying outrageous amount of taxes on the income you're collecting. You've got to shelter it. You would do better by taking on debt, buying bigger, better properties. Your rate of return will be much higher, that we just talked about, right? And Marianne, you were showing on the screen. So it would be higher if you would do that. And a lot of folks, they're looking at cash flow and not rate of return and cash flow. You got to have both.
Yeah, I feel like too, people look at their age and taking on debt and what that looks like to them, you know, and maybe it's not something that they're comfortable with. But I feel like if you sit down with a well-versed 1031 tax exchange or specialist, or well-versed CPA who can explain it to you, why that's a benefit to you, regardless of age or where you are in your life. You're not throwing money down the toilet by paying taxes. You're reinvesting your money for all intents and purposes.
I agree with you. I think you're right on target, but I do have one thing to
that
say.
needs to happen.
What do you use that formula you gave us at the beginning? We can show them, look at your rate of return.
Right.
No. And if they're okay with that, that's fine. But you know, let me tell you something. I do know this because I'm a little older than both of you, but not put together.
Yeah,
so here's the deal.
Not a lot older, pal.
Yeah, okay. So here's the deal.
I don't have gray hair either, so I'm sorry.
Yeah. Only his hair color, his hairdresser knows for sure, folks. But here's the deal, okay? When you retire, what's the number one thing you need more than anything else? Cash flow. Why? Because when you retire, you got to go to Costco. You're going to go out to dinner. You're going to travel. You're going to spend money, and you're not out there making it anymore. So your money has to come from your investments. Yes, from Social Security, but that ain't going to cut it. and you know that as well as I do.
No.
And you're going to need money from your other properties. If you feel that your properties are producing what you want it to be, and you could retire with that, then you may not need to do a 1031 exchange because the rate of return may be lousy, but the cash flow is good for you. It will meet your needs. That's fine. But if you're not retired and you're watching this video, you really need to rethink this. And you really need to look at rate of return harder than the retired person does. Because for you to get to a cash flow place in your life, so when it's time for you to retire, you've got to have those properties working for you. And releveraging by doing a 1031 exchange is the perfect fix. Yeah. Because when you retire, you will then need the cash flow. And all you're doing is building properties for your retirement. It's a wonderful thing.
Yeah, it also lends itself to understanding what you're leaving behind for your loved ones. If you're looking to grow your financial wealth through your real estate and leave it to your children or grandchildren or whomever's next in line, you want to make sure that they're in the best position financially as possible. Because if you're, not reinvesting your properties, or you're not taking care of the depreciation as you should, then they're going to end up having to do those things, and maybe they won't understand it, or maybe they just decide it's too much work and then they sell those properties.
There's your stepped up basis when you pass, and then they'll take the properties and the monies and do what they think is going to be best for them. Those things you can't control, but the bottom line is that you can make the best out of this that you worked so hard for all your career and all your life. And you know what the biggest regret is for most investors? I'll be honest with you. The number one regret is they didn't buy one more property or two more properties when they could have had all these rising properties in value. Yeah. The equities have grown. And frankly, how about the monthly income they would be?
Why did I sell that piece of property when I was 30 and have it free and clear right now? Or buying other properties with it. I get it.
Yeah.
And that's the biggest regret. There's three regrets in the world. Things that you said that you can't take back. Things that you didn't say that you should have said by stepping up. And the third one is you pass another opportunity to buy property. When I was first in the business in 1982, I remember one of the title companies, one of our competitors, used to hand out this little piece of paper, and it was a guy wearing a green cap. It almost looks like some kind of a weird suit that he had on. He had a big cane, big pole, and his beard flowed all the way down to the ground. And the title was, "This is a picture of a young man waiting for property values to go down." I'll never forget that. I wish I can find it somewhere, put it in a frame and put it up. Folks, it always goes back up again. Even when it crashes and burns, it's like the seasons that change. It goes back up higher than it used to be. That's just the way it works. And this is a good opportunity.
Thank you very much, Phil, for today. We appreciate it.
Yeah,
you're welcome.
That people see as much value in 1031 exchange as we do, and that they start calling.
And if your clients have any questions,
ask
that direct number is there for them to call me. It goes directly to me. I'd be happy to answer their questions. I'm good about returning my calls. There's never any requirement or obligation to call and ask some questions. But the bottom line is everybody's in charge of their financial future. They just have to make decisions.
Right.
Correct.
And this is a good decision. Of all the people that I don't know, that that I know, who are the most affluent financially, how many of them own investment real estate in their portfolio?
Right.
Almost all of them.
Well, we have our information on here, and they can either call us too, and if we can't answer and they're either afraid or don't want to call you, we can call you and get back to them, or call Phil direct, like he said, because he will answer your questions, and he is good at what he's done. And I have done a number of 1031s through Phil and his company. Exchange Resources is really, really good, and they've even sent me some stuff. So glad to have you today. Hope we can do another one covering some other stuff on this.
Yes. Thank you, Phil.
You're welcome. I wish everybody all the best. Thank you for putting this on today.
All right. Have a great day.
Take care, brother.
Bye-bye.
Bye.
We're not gonna stay in here till we go bye. But we're still here.
Hey,